Welcome to the Skilled MBA Finance Case Study Series, where we explore real-world ventures that embody financial innovation, strategic thinking, and long-term value creation. In 2023, MAPFRE United States of America, a key player in the insurance and investment space, faced unexpected turbulence during the collapse of Silicon Valley Bank. While the crisis sent shockwaves through the financial system, it also exposed vulnerabilities in MAPFRE's bond portfolio, specifically its sensitivity to rising interest rates. As markets panicked and yields surged, MAPFRE's bond holdings, which carried long durations, declined sharply in value. This case study explores how duration risk, often overlooked in stable markets, can pose significant challenges in volatile environments. It sheds light on the mechanics of interest rate risk, asset-liability mismatch, and the role of duration in fixed income strategy. Beyond the technical analysis, this case underscores a vital truth in institutional investing. Resilience requires not just diversification, but a deep understanding of how macroeconomic shifts can ripple across balance sheets. MAPFRE's experience serves as a cautionary tale and a learning opportunity for asset managers navigating today's rapidly changing rate environment. MAPFRE, United States of America, a conservative insurer, faced significant challenges due to the Silicon Valley Bank crisis. Their bond portfolio, heavily exposed to interest rate fluctuations, suffered as rates rose. This situation highlighted the insurer's vulnerability to market volatility, emphasizing the need for robust risk management strategies to mitigate exposure to such financial disruptions. Silicon Valley Bank's collapse in March 2023 was a result of rising interest rates causing mark-to-market losses on long-term bonds, a concentrated deposit base from venture capital-backed startups leading to rapid withdrawals, and an asset-liability mismatch where short-term deposits funded long-duration assets, creating severe liquidity challenges. In 2021 to 2022, SVB saw massive deposit inflows, investing in long-term treasury and mortgage-backed securities. By 2022, aggressive Federal Reserve interest rate hikes devalued SVB's bond portfolio. On March 8, 2023, SVB announced a 1.75 lakh crore loss, triggering a bank run on March 9th to 10th, with 33,000 crore withdrawn, leading to its closure. MAPFRE United States of America, known for its conservative investment approach, faced significant challenges when SVB Financial Group collapsed. The insurer experienced substantial mark-to-market losses on its bond holdings, prompting an urgent reassessment of credit risk exposure to financial institutions. This situation raised critical questions about the adequacy of MAPFRE's due diligence processes in managing such risks. SVB's bond portfolio was highly sensitive to interest rate hikes due to its high duration, leading to significant unrealized losses. These losses became real when SVB had to sell bonds prematurely during a liquidity crunch, as depositors demanded their funds. This situation underscores the critical impact of duration risk and liquidity management in financial stability. This case highlights key financial concepts: bond price sensitivity amid rapid monetary tightening, differences in accounting for available for sale versus held to maturity securities, the phenomenon of digital bank runs in the social media era, and regulatory oversight gaps in managing interest rate risks. These elements are crucial for understanding the financial landscape and its vulnerabilities. SVB's classification of securities as held to maturity allowed it to avoid mark-to-market accounting, masking the economic reality of losses. By Q4 2022, unrealized losses reached approximately 15,000 crore rupees, surpassing total equity capital. This lack of transparency forced investors like MAPFRE to scrutinize footnotes to grasp SVB's interest rate exposure severity. Silicon Valley Bank's downfall was rooted in a critical asset-liability mismatch. The bank's assets were long-duration securities, like 10-plus-year treasury and mortgage bonds, locked at low rates, Meanwhile, its liabilities were short-term, uninsured technology company deposits. When withdrawals surged, Silicon Valley Bank liquidated these assets at substantial losses, leading to its collapse. MAPFRE should have closely examined SVB bonds' duration and interest rate sensitivity. Balancing yield objectives with credit risk requires a thorough analysis of financial sector bond stability. Implementing hedging strategies, such as interest rate swaps, could mitigate losses. Enhanced stress testing for interest rate shocks is crucial for protecting bond portfolios against sudden market changes. Monetary policy shifts can significantly impact fixed income portfolios, necessitating a deep understanding of macroeconomic factors. Developing robust credit risk evaluation frameworks is crucial for identifying hidden vulnerabilities in financial institutions. Effective asset liability management strategies ensure duration matching in portfolios, while diversification approaches are essential for building resilience against systemic financial sector stress. The Federal Deposit Insurance Corporation's takeover of Silicon Valley Bank and the Federal Reserve's Bank Term Funding Program highlight immediate regulatory interventions. Medium-term changes propose stricter interest rate risk management and enhanced liquidity stress testing for mid-sized banks. Long-term reforms include debates on deposit insurance limits and scrutiny of held-to-maturity accounting, aiming to overhaul bank supervision with a focus on interest rate risk. Institutional investors must reassess bond investment strategies. Even investment-grade bonds can experience unexpected credit events. Traditional credit ratings may not reveal interest rate vulnerabilities. Asset liability matching is essential, and portfolio diversification should consider correlated financial sector risks. Enhanced scenario analysis must incorporate extreme interest rate scenarios to ensure robust risk management. Enhanced scrutiny is essential. Delve deeper than credit ratings to assess balance sheet vulnerabilities, focusing on interest rate sensitivity and liquidity profiles. Implement robust hedging strategies for interest rate risks in volatile environments. Ensure true diversification by addressing common vulnerabilities across the financial sector. Conduct regular stress tests, incorporating rapid interest rate movements to prepare for extreme scenarios. Thank you for exploring this finance-driven case with Skilled MBA. Explore Skilled MBA's extensive library for finance case studies, offering in-depth analyses of recent market events and institutional investment challenges. Access resources to enhance your understanding of risk management, portfolio diversification, and stress testing strategies. For more information, contact us via mobile at +91 875 53 00795 or email support@skilledmba.com.